Shield Insurance News Report, February 11, 2026. Disclaimer: this content is for informational purposes only. It is not legal, medical, financial, or official advice. Do not treat anecdotal stories, regulatory updates, or market commentary as guidance. Always consult a licensed professional for decisions involving insurance, risk, or compliance. Report Overview. 1. Allstate announces major auto rate reductions in 12 states. Allstate confirmed it will lower auto insurance premiums across 12 states following improved loss ratios and reduced claim severity. Reductions range from 3% to 11%, depending on the state. Analysts say this signals stabilization after 2 years of aggressive rate hikes across the industry. 2. FEMA updates flood maps for 2026 cycle. FEMA released its latest flood insurance rate map, firm, updates, impacting over 420,000 properties nationwide. Thousands of homes in coastal regions were moved into higher risk zones, increasing required NFIP premiums. Conversely, 60,000 properties were downgraded to lower risk categories, reducing annual costs. 3. Cyber insurance premiums rise again. Cyber insurance rates increased 8% quarter over quarter, driven by ransomware severity and cloud infrastructure attacks. Underwriters are tightening requirements around MFA, endpoint monitoring, and incident response plans. Brokers report that companies without documented security controls face 20 to 40% surcharges. 4. State Farm faces class action over roof claims. A new class action lawsuit alleges State Farm improperly denied roof damage claims by using unapproved inspection criteria. Plaintiffs argue the insurer systematically rejected wind damage claims after 2023's severe storm season. State Farm denies wrongdoing and says its methods comply with state regulations. 5. Medicare Advantage sees record enrollment. CMS reported Medicare Advantage enrollment surpassing 34 million, the highest in program history. Growth is driven by expanded supplemental benefits, including dental, OTC allowances, and transportation. Some watchdog groups warn that aggressive marketing practices may face regulatory scrutiny in 2026. 6. Viral insurance product of the day, Gadget Gap Micro Coverage. A new $5 per month micro insurance plan covering lost earbuds, chargers, and small electronics went viral on TikTok. Sign UPS surged after influencers highlighted that no deductible feature. Early resale angle, promotional bundles including branded cases are reselling for 3 times retail. 7. High-value resale item, 2021 Lloyds of London commemorative coins. A limited run of Lloyds of London silver coins originally priced at $89 now sells for $350 to $420. Collectors cite the coin's rarity and insurance industry historical significance. Insurance Daily News, February 11, 2026. Global Insurance and Risk Industry Update, spoken by AI. Market Snapshot, Key Insurance Indicators. The insurance industry is seeing a mix of easing costs in some areas and rising pressures in others. Below is a summary of key metrics and trends as of February 11, 2026. Indicator. Current figure. Recent trend. U.S. auto insurance premium, average annual. $2,697, full coverage, autobodynews.com. Plus 6% versus prior year, rate hike slowing, autobodynews.com. FEMA flood map revisions, 2026 update. For 20,000 plus properties reclassified. Thousands more in high-risk zones, premiums, 60,000 to lower risk, premiums. Cyber insurance pricing, Q4 2025, U.S. Plus 8% average premium change QOQ. Continuing to rise, ransomware losses high, was double digits in 2024, now moderating. Medicare Advantage enrollment, 2025. 34.1 million beneficiaries, KFF.org. Plus 7% versus 2024, record high, 54% of Medicare users, KFF.org. NFIP flood insurance premiums, Risk 2.0. $888 average annual premium, EST. Plus 12% since 2021, new rating model phased in, higher costs for many coastal homes. Sources: NAIC, FEMA, CMS, Marsh & Brokers. Premium figures are approximate averages. Trends reflect year-over-year or quarter-over-quarter changes as noted. Allstate leads auto rate reductions after 2 years of increases. Major premium relief. In a notable pivot for auto insurance customers, Allstate announced it is lowering auto insurance rates in a dozen states, with rate reductions ranging from 3% to 11% per state. This comes after 2 years of industry-wide premium hikes that sent auto insurance costs to all-time highs. Allstate's move, affecting some 7.8 million customers, is attributed to improvements in its underlying claims costs, notably improved loss ratios, the percentage of premiums paid out in claims, and reduced claim severity in recent quarters. Essentially, fewer and less expensive accidents are allowing the insurer to give money back to policyholders in the form of lower rates. AutobodyNews.com, AutobodyNews.com. Stabilizing after a surge. From 2021 through 2024, U.S. auto insurance premiums skyrocketed due to surging repair costs, higher accident severity, supply chain issues for car parts, and a spike in catastrophic claims, like hailstorms. In 2024, auto insurance was, in fact, the single largest contributor to U.S. inflation, with the average full coverage premium reaching $2,543, up 26% from the prior year. Insurers implemented aggressive rate increases to catch up with those costs. By mid-2025, however, data showed the trend moderating. The average premium in 2025 ticked up to about $2,697, roughly plus 6% year-on-year, a far gentler rise than seen in 2024. Analysts described the auto insurance market as stabilizing after years of turbulence, with some states even seeing net premium decreases by late 2025. AutobodyNews.com, AutobodyNews.com, AutobodyNews.com. State-by-state cuts. All states' rate cuts exemplify that turn. For instance, in California, after a 17.7% hike last year, State Farm, California's largest auto insurer, recently filed for a 6.2% rate decrease citing fewer costly physical damage claims. In Louisiana, Allstate received approval for a 7.6% rate decrease, effective January 1, 2026, following a drop in accidents and claims costs. And in Florida, the top 5 insurers collectively cut rates 6.5% on average in 2025 after legislative tort reforms reduced litigation expenses. These examples underscore how improving fundamentals, fewer accidents, legal reforms, are now translating to premium relief in select markets. AutobodyNews.com. Industry implications. While auto insurance remains expensive by historical standards, the recent pullback in rates in certain states is a welcome relief for consumers. It also suggests that the industry has returned to profitability after the pandemic-era upheaval. Allstate CEO Thomas Wilson noted that the company's auto insurance business restored margins to target levels by late 2025, thanks to its Transformation Growth Initiative and prior premium hikes. Now that losses are in check, Allstate can afford to compete on price again. Indeed, with this move, Allstate seems to be leaning into growth mode, aiming to retain and attract customers with more competitive rates, after having prioritized profit restoration for 2 years. Other insurers may follow suit in states where regulators approve decreases, especially if frequency, number of claims, remains low. Consumers in high-cost states should check with their agents during renewals in 2026 to see if they benefit from any rate relief. But experts caution that any broad national decline will be gradual and uneven. Industry-wide, U.S. auto premiums are still projected to rise about 7.5% on average in 2025, versus double digits prior, meaning many drivers will continue to see modest increases depending on location. For now, the biggest rate drops are concentrated in states like California, Florida, and Louisiana, locales that had seen some of the steepest increases earlier. Fool.com, AutobodyNews.com. FEMA 2026 flood maps, reclassified zones impact premiums. Flood risk remapping. The Federal Emergency Management Agency, FEMA, has rolled out its latest flood insurance rate map, FIRM, updates for 2026, an action that will impact flood insurance requirements and premiums for hundreds of thousands of U.S. property owners. According to FEMA data, over 420,000 properties nationwide are seeing changes to their flood zone designation with this cycle of map revisions. Many of these updates affect coastal and riverine communities that have grown or seen environmental changes since the last maps were drawn. The shifts cut both ways. Thousands of properties, especially in coastal counties along the Gulf and East Coast, are now newly designated in higher-risk flood zones, while roughly 60,000 properties, often in areas where new mitigation projects or updated modeling showed reduced risk, have been moved to lower-risk categories. Higher risk equals higher costs. For homeowners, these map changes carry significant insurance implications. Any property now mapped into a Special Flood Hazard Area, SFHA, the 100-year floodplain, with a federally backed mortgage will be required to carry flood insurance, typically through the National Flood Insurance Program, or NFIP. That means potentially thousands of households will need to purchase flood coverage for the first time, often costing several hundred to a couple $1,000s per year. Even those already insured could see premium increases. Moving from a moderate risk zone to a high risk zone can raise NFIP premiums substantially, though FEMA's Risk Rating 2.0 pricing system now sets rates more on home elevation and flooding likelihood than just zone alone. FEMA's Risk Rating 2.0, introduced in 2021, has already been gradually raising rates for many high-risk properties. The average NFIP premium is around $888 annually and climbing about 12% per year under caps. Newly rezoned homeowners can often initially qualify for FEMA's newly mapped discount on premiums, softening the blow in the first year, but their rates will then increment up each year until reaching the full risk cost. Agents.flow, smart.gov. Premium relief for some. On the flip side, about 60,000 properties nationwide have been downgraded to a lower risk category, e.g., moved out of the 100-year floodplain to a 500-year zone. Owners of those homes could see significantly lower NFIP premiums going forward. If they no longer are in an SFHA, lenders might even drop the mandatory coverage requirement, though maintaining some coverage is still advised. These changes often reflect new infrastructure, like improved levees or drainage systems, or updated flood modeling that shows less exposure than previously thought. For example, FEMA recently released draft updated maps for Harris County, Texas, Houston, the first major update there in nearly 20 years, which expand the high-risk floodplain to mirror realities observed during Hurricane Harvey. Such expansions in one area might be offset by improvements in another, a new dam or diversion lowering risk downstream, etc. Overall, the 2026 map updates underscore how dynamic flood risk is due to development and climate patterns. Yahoo.com. Homeowner to-dos. FEMA's updated firms will not become effective immediately. Once finalized, communities get a 6-month adoption window. Homeowners should check the new maps, available on FEMA's Flood Map Service Center or through local floodplain administrators, to see if their property's zone changed. If you were added to an SFHA, talk to your insurance agent about securing an NFIP policy before the maps go into effect. Doing so may lock in more favorable rates. Conversely, if you were removed from high risk, consult your lender. You might be able to drop coverage or at least enjoy lower premiums, though be mindful that Mother Nature doesn't always follow FEMA's lines on a map. Flood experts note that 25% of flood insurance claims come from outside high-risk zones, so maintaining some protection can still be wise. For policymakers, the large scope of changes, hundreds of thousands of properties, reinforces ongoing debates. As flood risks increase in some areas and mapping struggles to keep pace, there's mounting pressure to update infrastructure and possibly mandate broader flood coverage adoption beyond just SFHAs. Click to Houston.com, financialcontent.com, financialcontent.com, financialcontent.com. Cyber insurance, rates climb amid ransomware wave. Premiums up again. Cyber insurance continues to be a challenging market for businesses, as evidenced by another quarter of premium hikes. Industry reports show that cyber insurance premiums rose roughly 8% in Q4 2025, quarter over quarter, for U.S. policyholders on average. While less drastic than the double-digit quarterly jump seen in 2021 and 2022, this persistent upward trend keeps cyber coverage prices near all-time highs. By some measures, overall cyber insurance pricing has roughly doubled since 2020, though the rate of increase began moderating in late 2024 and into 2025. For context, some analyses actually indicate cyber premiums peaked and even dipped slightly, -3% to -5%, in late 2025 for well-secured clients, but many organizations, especially those without top-tier security, are still seeing price increases at renewal. The 8% QoQ rise figure suggests that on balance, underwriters are continuing to raise rates, albeit more selectively. BeInsure.com, RiskaNDinsurance.com, RiskaNDinsurance.com, BeInsure.com. Ransomware and cloud attacks, the key drivers of costly claims, and thus premium pressure, remain ransomware attacks, business email compromise, and other cyber breaches. Ransomware, in particular, has evolved into a multi-billion-dollar criminal industry that routinely forces insurers to pay large extortion demands or incident recovery costs. Although cyber defenses have improved, the proportion of companies paying ransoms has fallen, with only 20% of incidents resulting in ransom payment in 2025 versus 60% in 2019. The average size of data breaches and business interruption losses has grown. Additionally, cloud infrastructure attacks and supply chain hacks have emerged as major concerns, incidents where a compromise of a cloud service provider or software vendor can cascade to dozens of client companies. Such events, e.g., the notable cloud platform breach in mid-2025 that impacted multiple Fortune 500 firms, are raising alarm for insurers due to accumulation risk, many claims from one event. Consequently, reinsurers have started capping their exposure to widespread cyber events, which in turn keeps primary cyber insurance prices high. RiskaNDinsurance.com. Stricter underwriting, MFA or bust. Insurers are responding not just with higher premiums but with much stricter underwriting requirements. Many cyber insurers now require firms to demonstrate robust security measures in place, or else coverage will be denied or sharply surcharged. These measures include multi-factor authentication, MFA, on email and critical systems, advanced endpoint detection and response, EDR, software on all devices, encrypted backups, employee security training, and written incident response plans. According to cybersecurity legal experts, the mantra in the industry has become no MFA, no coverage. Indeed, there have been cases of claims denied because the victim company failed to utilize MFA, which was a condition of their policy. One survey found that over 50% of businesses had to implement MFA just to qualify for or renew cyber insurance in 2025. Insurers are also scrutinizing companies' network diagrams, cloud configurations, and even conducting their own scans of applicants' systems for vulnerabilities. AboveTheLaw.com, JumpCloud.com. Surcharges and coverage gaps. Companies that don't meet the ever-tightening security standards are often still offered policies but at significantly higher premiums, sometimes 20 to 40% surcharges on top of base rates, or with reduced coverage limits for certain risks. For example, an insurer might still insure a company lacking an endpoint monitoring system, but exclude any claim arising from a malware infection that better endpoint security could have prevented. Brokers report that some smaller businesses are essentially priced out of comprehensive cyber coverage due to these factors, at a time when they arguably need it most. The bright side is that for organizations with strong cybersecurity, MFA, updated systems, regular backups, etc., the market is somewhat stabilizing. Competition among insurers increased capacity in 2025, and such companies even saw slight premium decreases or opportunities to expand coverage for the same cost. Overall, cyber insurance remains a critical but costly safeguard. Analysts predict single-digit percentage price increases will persist through 2026, unless a severe wave of attacks prompts another spike. Businesses and law firms are advised to treat cyber risk mitigation as a top priority, not just to reduce the chance of an incident, but also to maintain insurability and manage insurance costs. BeInsure.com, BeInsure.com, AboveTheLaw.com. Litigation Watch, State Farm's roof damage claim dispute. Storm of lawsuits. Insurance giant State Farm is facing a wave of litigation over its handling of homeowners' roof damage claims from recent storm seasons. A newly filed class action lawsuit, and numerous individual suits, allege that State Farm systematically denied or underpaid roof replacement claims following major wind and hailstorms in 2023. According to the complaints, State Farm adjusters utilized unapproved inspection criteria that had the effect of classifying legitimate storm damage as wear and tear or cosmetic, thereby allowing the insurer to deny full payouts. In Oklahoma alone, more than 100 families have sued State Farm with claims that it schemed to deny hail damage claims and pocket billions by shortchanging customers on roof repairs. Lawyers involved in the case have uncovered internal communications suggesting that field offices were pressured to preemptively rule out full roof replacements, even when policyholders had extensive damage. K4.com. Alleged claims manipulation. one specific allegation is that State Farm only reimbursed for removing one layer of shingles when many roofs had two layers, thus underpaying each claim by a few $1,000s in disposal costs. To an individual homeowner, that might look like a modest shortfall, but across tens of thousands of claims it could save the insurer significant money. The lawsuits also claim that after a particularly severe hailstorm, State Farm instituted a policy of pre-denying roof claims, essentially instructing adjusters to default to denial unless damage was overwhelmingly obvious. In legal filings, examples are cited where homeowners with documented large hail impacts had their claims denied or only partially paid, forcing them to either pay out of pocket or live with damaged roofs. Some of these cases, when brought to court, have led to sizable settlements. In one Oklahoma case, NIDA versus State Farm, confidential settlements averaging around $3 million per household were reportedly paid, far above the $20 to $30K cost of a roof, suggesting plaintiffs uncovered troubling internal practices in discovery. Classaction.org, K4.com, K4.com. State Farm's response: State Farm vehemently denies any systematic wrongdoing. In a statement, the company said, every claim is unique and handled on its individual merits. The fact that someone files a lawsuit does not mean the allegations are true. We look forward to presenting the facts supporting our claim decisions in court. State Farm maintains that it followed state insurance regulations and its policies in adjusting roof claims, and that in many cases, damages did not meet the policy threshold for full roof replacement. Industry experts note that roof claims often spark disputes because policies sometimes contain depreciation schedules or cosmetic damage exclusions that are subject to interpretation. What one roofer deems a total loss, an insurer might consider reparable. However, the breadth of similar accusations against State Farm, across multiple states and storms, has put a spotlight on its claims practices. Regulators in a few states have also reportedly opened inquiries into whether insurers, State Farm and others, applied overly strict criteria for hail damage in 2023, given the unusually high volume of storms that year. K4.com. What homeowners should know: if you filed a storm damage claim that was denied or underpaid, consumer advocates suggest reviewing your policy and the adjuster's report closely. You may request a second inspection or hire a licensed public adjuster for an independent opinion. The State Farm cases illustrate that persistence can pay off. Some homeowners eventually secured far larger payouts after challenging the initial denial, either through internal appeals or litigation. More broadly, this situation underscores the importance of understanding your homeowner's coverage. Does your policy have full replacement cost coverage for roofs? Are there cosmetic damage exclusions or a separate wind/hail deductible? These factors can significantly affect claims outcomes. The class action suit could take months or years to resolve, but its progress will be closely watched. A ruling or settlement in favor of policyholders might lead to reimbursements for many customers and potentially changes in how carriers handle roof claims. Until then, State Farm and the plaintiffs' attorneys are gearing up for what could be a high-stakes legal battle in 2026. Medicare Advantage enrollment soars, alongside marketing scrutiny. Record MA enrollment. The Medicare Advantage (MA) program, private managed care plans that provide Medicare benefits, continues its explosive growth. The Centers for Medicare and Medicaid Services (CMS) reported that Medicare Advantage enrollment has surpassed 34 million beneficiaries as of early 2026, the highest in the program's history. That means about 54% of all Medicare-eligible seniors are now on Advantage plans rather than traditional Medicare, up from roughly 45% just 3 years ago. This milestone reflects a decade-long trend of seniors increasingly opting for MA plans, which are offered by insurers like United Healthcare, Humana, Aetna, and others. Despite some forecasts that enrollment might plateau or even slightly dip in 2026 due to insurer adjustments, the latest figures confirm that 2025 saw robust growth, roughly plus 7% enrollment year over year. KFF.org. What's driving the growth? Why are so many seniors choosing Medicare Advantage? One big reason is the attractive supplemental benefits these plans often include. Unlike standard fee-for-service Medicare, most MA plans bundle in extras such as dental, vision, and hearing coverage. Nearly 98% of plans offer these now, as well as perks like gym memberships, over-the-counter drug allowances, and meal delivery after hospital stays. For example, in 2025 about 73% of plans offered some quarterly allowance for OTC health items. In 2026 that's slightly down to 66%, but still a majority. Many plans also cover non-medical benefits like transportation to medical appointments. About a quarter of general plans, and 2/3 of special needs plans, provide ride benefits. These extras, combined with often low or $0 monthly premiums, 67% of MA plans have no premium beyond the standard Medicare Part B premium, make MA plans very appealing. Essentially, seniors can get more coverage for often less out-of-pocket cost, in exchange for agreeing to a plan's provider network and prior authorization rules. Surveys show those added benefits and potential cost savings are top reasons beneficiaries give for picking MA. KFF.org. Regulatory eyes on marketing. However, this rapid enrollment growth has drawn regulatory scrutiny, particularly around how Medicare Advantage plans are marketed to seniors. Federal regulators and watchdog groups have voiced concerns that some marketing tactics used in recent years have been misleading or overly aggressive. The HHS Office of Inspector General in late 2024 issued a special fraud alert detailing problematic practices, fake or deceptive mailers and robocalls, confusion tactics implying certain doctors or benefits that don't actually exist in a plan, and high-pressure sales targeting vulnerable seniors. In fact, CMS tightened rules for MA plan telemarketing in 2023 and 2024 after a surge in complaints, requiring call recording, standard disclaimers, this is a solicitation for insurance, and banning certain celebrity-driven TV ads that purported to offer free benefits. Watchdog groups like the Center for Medicare Advocacy have also flagged how some brokers may enroll seniors in plans that aren't the best fit, through incomplete information or incentives. DJHoldLaw.com. For 2026, CMS officials signaled they will closely monitor MA enrollment to ensure it remains driven by genuine beneficiary choice and not by deceptive marketing. There's also rising scrutiny on network adequacy and denials. Recent reports found some MA plans have high rates of denying or delaying care authorizations compared to traditional Medicare, prompting questions if plans are sometimes prioritizing profits over patient care. Despite these issues, overall satisfaction with MA plans remains relatively high in surveys, and the value proposition, more benefits, caps on out-of-pocket costs, continues to attract seniors. The industry's main trade group, Better Medicare Alliance, emphasizes that average MA premiums for 2026 dropped to about $14 and that plans remained popular for delivering comprehensive care at lower costs. Still, consumers should be diligent. During open enrollment, compare not just premiums but also drug formularies, provider networks, and the specifics of those extra benefits, which can vary widely in scope. And be wary of any marketing that sounds too good to be true. The bottom line, Medicare Advantage is now the dominant form of Medicare, and with that status comes increased oversight to ensure seniors truly get the advantages they're promised. Trending in insurance, Gadget micro-coverage and Lloyd's collectible coins. Finally, two lighter developments are creating buzz in the insurance world. Gadget Gap Microinsurance goes viral. A new InsuranceTech startup's product, nicknamed Gadget Gap, has become a social media sensation by offering microinsurance for everyday electronics. For about $5 per month, consumers can insure small personal tech items, think wireless earbuds, phone chargers, fitness trackers, against loss or damage. Importantly, the plan features no deductible and near-instant claims processing via a mobile app. TikTok influencers latched onto Gadget Gap in viral videos, touting how it even covers misplacing your AirPods or dropping a portable charger in a puddle without any out-of-pocket cost. These clips, some garnering millions of views, drove a surge of sign-ups among Gen Z and millennials who often balk at traditional insurance. Within a week of trending, the startup reported thousands of new policies. Industry observers say this highlights a growing demand for micro-coverages, bite-sized insurance for specific needs, especially when packaged in a fun, affordable way. It also raises questions: will claims frequency be sustainable at that $5 price point? Will larger insurers replicate this model? For now, Gadget Gap's virality is a marketing win, and it's introducing a younger audience to the idea that insurance can be accessible for even minor everyday mishaps. Lloyd's of London coin resale boom. A niche collectible is fetching big dollars among insurance history aficionados. In 2021, to commemorate a milestone, likely Lloyd's 335th anniversary, a limited batch of Lloyd's of London silver coins was minted and sold for around $89 each. Fast forward to 2026, and those coins are now resurfacing on secondary markets, with asking prices between $350 and $420. Collectors cite the coin's rarity, only a few thousand were produced, and it's tied to the iconic Lloyd's insurance marketplace as driving demand. The coin itself features Lloyd's famous headquarters building design in the year 2021, making it a unique crossover of numismatics and insurance lore. Enthusiasts within the insurance community have been exchanging the coins as gifts or selling them via online auctions, where bidding wars have broken out. While not a mainstream investment, it's a reminder that even the insurance industry has its memorabilia and fans. For those lucky enough to have bought the coin in 2021, its value has quadrupled, outperforming many stocks. Not a bad hedge at all, though admittedly far less liquid. And for everyone else, it's a quirky conversation piece about the length and legacy of the insurance market. After all, how many industries can claim a continuous history back to the 17th century, deserving of a silver keepsake? Video script, Insurance Daily News, February 11, 2026. Intro music fades in. Anchor, AI voice. Hello and welcome to Insurance Daily News, spoken by AI, bringing you fast and reliable updates on insurance markets, regulatory changes, claims trends, and more. Today is February 11, 2026, and here are your